Welcome everybody today. Today we're going to talk about international tax and the new tax reforms. I will flip right through. Today I am fortunate enough to have with me Will Hooker, who is a senior manager out of our Atlanta office in the international tax practice. And I also have Randall Cathell with me, who heads up our practice in the South Florida area and is located in the Coral Gables area. And then I'll flip right through. I'm going to flip back real quick. When we're talking about goals for today, I would like to, you all can read that on the screen. I think what I'd like to point out is, before we get into the details, kind of, if I were going through this presentation, what are the three takeaways that I would want to convey to everyone today and to walk away from international tax reform? I think the first one I'm going to mention is a good thing and provides a lot more opportunity and planning opportunities from a tax savings perspective. Unfortunately, the second two, number two and number three I'll mention, are not as fortunate, but they do merit things that people should consider. First and foremost, and I'm sure you all have heard in the news about moving to a territorial system. That will be applicable for many of you. But what I would say is the number one thing is evaluating your global structure from 2018 forward. There is now an opportunity to invest in a particular structure type that would allow you to bring back foreign earnings into the U.S. without additional U.S. taxation. That is not available to everyone in every structure, so it is really comes down to, do you want to invest in a C-Corp structure or a pass-through structure? And one structure gives you the new territorial regime, while the second structure would remain very similar to what we have today with some modifications that we will get into in detail. So the number one thing is a good thing. We have territorial system available in certain cases for people, and so there's an opportunity to evaluate your global structure and whether you are currently in the right structure or whether the new territorial regime would apply to you and whether it give benefit. Number two, I think, is unfortunately to move to the territorial structure. What Congress did is they decided for all deferred foreign earnings, and we're going to get into this in detail, people are going to have to pick up that tax, those earnings immediately, and pay tax on it. So unfortunately for your 2017 tax year, which just closed, for those that have deferred foreign earnings, you may have to pick that up in your 2017 tax year and pay tax on that, albeit at reduced rates, but you could have a tax bill. Will be talking about that today. There are opportunities to defer payment on that tax, and there are opportunities to pay in installments, which have election requirements and are pretty critical that you pay attention very quickly if you're going to make those elections, because they are can be a trap for the unwary. I think the third thing I'd take away from this is, as you know, Speaker Ryan talked about putting things on a postcard and filing your taxes, and it would be simple. I think that may be possible if you own a smartphone and it has 256 of gig and you can access the cloud. You may be able to complete that on a smartphone that's the size of a postcard. It may be difficult, but you would be able to complete it. I think the real message is, unfortunately, in the international arena, reporting and tracking is going to become more comprehensive. It's going to become more complicated, and as you will see in certain instances, the penalty regime has also been increased. So I'd say that as we get into this, the three takeaways are: there is an opportunity to redefine your global structure with the new territorial regime. There is a tax for the 2017 tax year on deferred foreign earnings that you need to pay attention to. And then number three, I think the reporting and compliance of your foreign activities are going to become more comprehensive and more complicated. So today, what we're going to cover is, will head us off with the Section 965, and that's the tax on deferred foreign earnings, and that's a 2017 item. Will also cover some items under Subpart F Income, which is really the U.S. anti-deferral rules, i.e. picking up income in the U.S. on deferred foreign earnings, how that will change. You look down at the third bullet point on GILTI and FDII. That is all about new lower taxed and non-deferral on certain intangible types of income. And then we'll move with Randall, who will talk about our new territorial system and whether it may apply to you. There are several miscellaneous provisions that we'll be applying that we'll talk about. Please note that the international section alone of the bill is 150 pages of new tax code. So it is voluminous, and it is a lot to consider. And there are opportunities, but there will be issues we need to cover. And then Randall will also cover the foreign tax credit system. There are going to be modifications to it from categories, who can take foreign tax credits, foreign tax credit opportunities that are actually going away. And then finally, Randall will finish up with tax provision considerations in the financial statements, especially on the international side, and what one should consider. Okay, I'm going to now hand it over to Will and Section 965. Will?
Thank you, Brian. This is Will Hooker. I'm Senior Manager with Terry Bekaert's International Tax Group in Atlanta. And I want to start today with this Section 965 mandatory inclusion of deferred foreign income. So let's start kind of with a high-level overview. I would say the first thing to point out, this may impact your 2017 tax return. So a lot of what we'll discuss today goes into effect January 1, 2018, but this can actually impact in the form of an additional tax on your 17 return. So this is an immediate need to look at. So what is it? It's, as you see here, mandatory income inclusion for U.S. shareholders' share of the foreign corp's income accumulated after 1986 that has not been taxed in the U.S. So potentially a long look-back period here because we're going post-86 through end of 17. It's a one-time tax designed to transition us to this new modified territorial system that Randall will describe in more detail later. There is, I guess, a little bit of a silver lining with this tax, third bullet point. Once this tax is paid, all of those pre-2018 earnings can then be distributed up with no additional U.S. tax due. It would be like a distribution of previously taxed income, if anyone's familiar with the Subpart F rules. Let's move on to the next slide. So who is impacted by Section 965? Here, let's talk about two key definitions. U.S. shareholders of deferred foreign income corporations are those who are impacted. So what is a deferred foreign income corp? It's a CFC, or a controlled foreign corporation, but it's broader than just a CFC. It also can include a foreign corporation that has, say, only one U.S. C Corp that owns 10% or more that may not otherwise be a CFC. A deferred foreign income corp is also only one that has a positive accumulated post-86 deferred foreign income amount. If you are familiar with the Form 5471 that's attached to U.S. tax returns, what we're generally talking about there is the amount of accumulated E&P on Schedule J. A U.S. shareholder includes any type of U.S. person, so individual or entity, who directly or indirectly owns 10% or more of the foreign corp. So what is the amount of this 965 income inclusion? I think, well, the answer is pro rata share. It's a U.S. shareholder's pro rata share of net accumulated deferred foreign income. So to drill down there, I think it would help if we break down that answer into its parts. So let's start with deferred foreign income. That is generally the foreign corporation's E&P, earnings and profits, that has not yet been taxed in the U.S. And it's not just any deferred income, it's accumulated deferred foreign income. By accumulated, we mean post-1986 through 12/31/17, unless the amount through November 2nd, 2017 is greater, and that November 2nd date generally coincides with when details of these provisions came out. So essentially they're preventing taxpayers from avoiding this tax by leaking E&P out of their foreign subs. And I mentioned deferred foreign income, that second point down, that does exclude previously taxed income, PTI, as well as income effectively connected with U.S. trade or business, or ECI. It's also not reduced by any amount of actual 2017 dividend distribution. So if you had a dividend from your CFC during the 17 year, we do not let that amount reduce the E&P, but we add it back essentially and compute the 965 on the total E&P. And then also net, it's net accumulated deferred foreign income. And looking at the last point, what that means is we are allowed a bit of a break here, where if you have multiple foreign corporate subsidiaries, where say one or more of those subs has an E&P deficit, so an accumulated negative E&P amount, you can use that and allocate it against positive E&P of your other foreign subsidiaries. So what is the effective tax rate on the deferred foreign income? It is 8% or 15.5%, depending on the extent of the shareholder's aggregate foreign cash position. These 8% and 15.5% rates are arrived at through a deduction mechanism that is illustrated here on the example below. So if we start with this, this is a simple example. We have U.S. Inc., which is a C Corp in the U.S., wholly owns two foreign subsidiaries, FCO 1, FCO 2. We have the simplified tax attributes of each foreign company, as well as cash balance sheet accounts for 17. So essentially the effective tax rate is arrived at by allocating, taking the total deferred income amount, which is 1,000, so that's your 965 inclusion amount. The rules do allow a deduction, so for the cash portion of that, which in this case is 300, there's a 55.7% deduction, so the actual taxable inclusion is only 133 of the 300. A larger allowable deduction for the non-cash to allow a larger deduction, and at the end of the day, for a U.S. corporation at 35% tax rate, the effective rate is going to be 15.5% for cash and 8% for the deferred foreign income held in the form of non-cash. And so if we move on to the next slide here, we get a little more detail. What do we mean by aggregate foreign cash position? So essentially, it's the U.S. shareholders' aggregate pro rata share of the cash position of each of its foreign corporations at the greater of the close of the 12/31, or I'm sorry, the tax year beginning before 2018, which for many is 12/31/17, or the average of the cash position for the two most recent tax years. So if you're a 12/31 year end, that would require you to look back to 2015 and 16. Here, cash, as you might expect, includes obviously cash, net accounts receivable, as well as fair market value of certain assets listed here. So for U.S. C corporations incurring this tax, they are allowed a limited foreign tax credit. These foreign tax credits, I say limited because they are proportionately reduced by those same deduction percentages we saw in the previous slide that arrive at the deduction amounts. And I think it may be a little bit easier if we go on to an example on the next slide. And so if we recall our tax pool attributes from FCO 1 and FCO 2, as well as the cash positions relative to the 965 inclusion amounts, we can compute the amount of the allowed foreign tax credit. So let's start with the table on the left. We multiply 55.7% by essentially the ratio of aggregate foreign cash to the total inclusion. That gives us 16.7. Then we multiply that set 77.1% rate by the ratio of non-cash to the total inclusion. We add those two percentages together, and that gives us the applicable foreign tax credit disallowance percentage, and we apply that to the tax pools because we take the entire tax amount because all taxes are deemed to come up with all the earnings and profits. And that gives us the amount of foreign tax credit disallowed, and so we net that against the tax pool. And at the bottom there, you see the foreign tax credit allowed amount, 29 and 59 for FCO 1 and FCO 2 respectively, giving us a total foreign tax credit of 88. So continuing our example here to arrive at, what is the actual U.S. tax due on this 965 example. If you recall from previous slide, we took the deduction from the gross 965 inclusion amount to get to a total of 293 taxable inclusion. Then we gross up by the foreign tax credit amount of 88 and compute our total U.S. tax liability of 134. But then again, we get that foreign tax credit of 88 to arrive at U.S. tax due of only 46. So end of the day, for this 1,000, in this, I'd say a pretty simple example, the $1,000 inclusion, we get a 4.6% effective tax rate. Now that is given the tax attributes and other attributes of the FCO 1 and FCO 2, so any taxpayer's situation will differ depending on specific facts and attributes of its foreign subs. As Brian mentioned earlier, there are some elections that actually can benefit taxpayers. Any U.S. shareholder of a deferred foreign income corp subject to this tax may elect to pay that total tax over an 8-year installment period. And that 8-year period is backloaded, so you pay less up front and more in the last 2 or 3 years. If you are an S corporation shareholder, there is a special provision for you. You get to actually defer paying this 965 tax, and you can defer paying it essentially indefinitely until one of the specifically defined triggering events occurs. There are 3 different enumerated triggering events. Essentially, they all involve exiting from the S Corp. And so as long as you essentially remain S Corp, in the S Corp, you can defer. One important thing to note, though, for the S Corp itself, the code requires that it has joint and several liability for any tax amounts deferred by its shareholders under this election. So the other S Corp shareholders may want to keep that in mind if one of their other shareholders elects to defer. There is reporting required even if you do defer. And one other thing about the deferral, you can still elect to to pay in installments once a triggering event occurs, unless that triggering event involves essentially a ceasing of business or liquidating the S-Corp. I guess the thought is if the S-Corp goes away, the IRS wants its money now, not in installments, because you may not be around much longer. Important to note for this tax filing season, the timing of these elections are the due date of the 17 return without extension. So that's coming up pretty quickly for most of us. Okay, so let's move on to the next topic, a quick update on the Subpart F income provisions. And as Brian mentioned earlier, Subpart F income, we generally mean the anti-deferral rules that come into play if you're a U.S. shareholder of a controlled foreign corporation. So Randall will talk about the modified territorial system later, but as he does talk through it, just keep in mind that these Subpart F income rules are alive and well. They are not going away, unfortunately. So all U.S. shareholders, regardless whether you're individual or C Corp, remain subject to Sub-F income recognition. But there are a couple of changes here effective this year, 2018. Sub-F no longer includes oil-related income, and it no longer includes previously excluded income withdrawn from qualified shipping investments. So that was Section 955, which has now been repealed. There is a broader reach of Subpart F. So for instance, there is no longer a 30-day minimum holding period, and U.S. shareholder not only includes 10% of vote, but it also includes 10% of value. So that may come into play in some unique fact circumstances. Another small provision, that the constructive ownership rules have been expanded such that stock owned by a foreign person may now be attributed down the chain to a related U.S. person for purposes of determining CFC status and U.S. shareholder status. So that last point, it may not come into play, but if you have maybe a more unique global structure where there are related U.S., non-U.S. Common owners, I would advise you to revisit your global structure and see if these constructive ownership rules, the changes may trip you up. And then finally, as we'll get into more here soon after this, a new Subpart F income provision under 951 Cap A. It impacts shareholders for their income described as GILTI, G-I-L-T-I, as we'll see here later, and that means global intangible low-taxed income. So what is that? It's similar to, or the way it's included is similar to Subpart F. Any U.S. shareholder of a CFC must include this amount. And what GILTI is it generally results, in taxation of U.S. shareholders on the combined net income of all of its CFCs that, one, is not otherwise taxed in the U.S. on a current basis, and secondly, exceeds a fixed rate of return on the CFC's business assets. There's a lot more to it than that. This understanding of this new fairly complicated provision requires some deep understanding of new terminology as well as some new calculations. So let's get into that. This is a deceptively simple slide. It's basically the calculation of GILTI, and that's simply net CFC tested income less net deemed tangible income return gives you your GILTI amount. However, as you probably imagine, there's some layers to peel back here for both of these amounts. So the tested income, or to determine net CFC tested income, we first start with tested income, and then we subtract from that the tested loss. So tested income is basically the CFC's gross income, but we exclude certain items. The items we exclude include effectively connected income, or ECI, Subpart F income that's excluded by reason of the high tax exception, or high tax kickout rather, as well as just other types of Subpart F income. It also excludes dividends received from a related party, and it excludes foreign oil and gas extraction income. So it's not just simply the CFC's gross income, but we have to look and see what amounts do we exclude from that. And then we subtract from that some allocable deductions. A tested loss of a CFC is simply if there's a negative tested income amount. And again, when we're talking about the U.S. shareholder level, we're talking about the sum of that U.S. shareholder's pro rata share of each CFC's tested income over tested loss. So when you have multiple CFCs in the structure, that's, you can imagine, becomes a fairly involved calc. Next, the other piece to that GILTI calculation is net deemed tangible income return. And by that, we are generally talking about a fixed return on the CFC's tangible income producing property. And so this net deemed tangible income amount is basically calculated as 10% of the U.S. shareholders' aggregate pro rata share of what's defined, or what we will learn the definition of, qualified business asset investments of each CFC, less certain interest expense amounts. And the interest expenses in question here are basically those attributable to interest income that was not included in the tested income. So I know that's a lot to follow. So let's look a little bit more closely at what we mean by qualified business asset investment, or QBAI. This is referring to the CFC's quarterly average aggregate adjusted basis in certain property. And the property we're talking about here includes depreciable property used for the production of tested income in the CFC's trader business. So QBAI does not include all assets or all property, but only this certain type of property. And our adjusted basis, because again, we're taking the quarterly average of the adjusted basis in this type of property, that adjusted basis is determined using the alternative depreciation system under 168G. And next, there is a limited foreign tax credit available under GILTI, but only for U.S. C corporations. So if you are an individual, say, owning CFC stock through a partnership or S corp, unfortunately, you do not get this foreign tax credit. The foreign tax credit is available under, for C corps, is available under Section 960, but gets essentially a 20% haircut. So we take 80% of the ratio of the GILTI amount we computed relative to the total or aggregate tested income, and we multiply that by the aggregate tested foreign income taxes of the CFCs. So again, we'd look at the tax pools of the CFCs to get that tax amount that we can claim the foreign tax credit on. One thing to note there, if you have any CFCs with a tested loss, you do not get to include their foreign income taxes paid or accrued in this calculation. So it's only positive tested income CFCs. There is a separate basket for those of you familiar with the foreign tax credit limitation calc. So this GILTI is essentially handled separately, and there's no carryover or carryback of excess taxes in that FTC basket. Okay. And then finally, there's a new provision under Section 250 for foreign-derived intangible income, or FDII. This one is also only available for U.S. C corporations, so not for individuals or others. And essentially what this does is the U.S. is trying to create disincentives to move IP outside the U.S. And so what they're doing is they're allowing deductions to effectively yield a tax rate of 13.25% on certain income that meets this foreign-derived intangible income. And what that is, basically, it's goods or services provided to a foreign person, or in some cases through a U.S. intermediary for ultimate foreign use. So that would be property sold to any foreign person or services provided to any foreign person. So this is a potential benefit for U.S. taxpayers. Again, this is new for 2018 going forward. And with that, I know that was a lot to go through, but I'll hand it over to Randall, and he's going to talk about the new dividend received deduction.
Thanks, Will. Yeah, this is Randall Cathell, and I'm based here in South Florida. I'm going to start off with a discussion of the foreign source dividends received deduction. So, as part of the good news from the Tax Reform Act is that going forward, to the extent that you have a foreign corporation, there is the ability to repatriate tax-free those foreign source dividends. Again, this only applies to the extent that they are received by a domestic corporation. So to the extent that there is ownership by an S-corp, partnership, or individual directly, that provision will not apply necessarily. In terms of how this does apply, it applies to specified 10% foreign-owned corporations, or SFCs. And those are defined as foreign corporations that are owned 10% or more by domestic corporation. Means that excludes PFICs that are not CFCs, and also the DRD provisions do not extend to REITs and RICs. To the extent that you have a foreign source dividend which receives a DRD treatment, there are foreign tax credits which are disallowed. So as we'll get to in a minute, there's some additional foreign tax credit baskets, to be more precise, but to the extent that you have a foreign tax credit which attaches to a foreign source dividend which has DRD treatment, it essentially evaporates. This also applies to the extent that there is a direct foreign tax under Section 901 for withholding taxes. Now, in computing the taxable income for a domestic corporation which receives foreign dividends which have DRD treatment, one must exclude deductions which are properly allocable to that foreign source income. There's some new holding period requirements with respect to dividends received deduction eligibility. As you may recall, in the past, there were some cases in which certain financial institutions assisted clients with exchanges of stock in order to increase foreign tax credits here in the U.S. for those recipients. So going forward, there is essentially a one-year holding period for that stock, as well as the SFC must also meet that holding period requirement for the DRD to apply. Now, when there are hybrid dividends, and a hybrid dividend is defined as a dividend which is paid by the payor in which they will receive a tax benefit. Say, there are certain instruments and entity structures which derive effectively an interest payment, which is from a U.S. perspective considered to be a dividend. those dividends did not receive the dividends received deduction. But as far as dividends under the DRD provision, these are broadly defined, luckily. So we have our direct foreign dividends, Section 1248 amounts, i.e. those capital gains which are recharacterized as dividends. To the extent we have a lower tier dividend from a CFC, which is otherwise treated as Subpart F income, that is also within scope. And dividends which are received through partnership holdings of a corporation also apply. Now, when you receive a dividend which is reduced by the DRD, this also has the effect of reducing the basis of that foreign corporation from the respect of the domestic shareholder. And to the extent that you have a foreign branch which has excess losses, which is converted to a foreign corporation, those transferred losses are recharacterized as U.S. source income to the transferring domestic corporation. And this is effective after 12/31 of 17. I'm going to go over a few miscellaneous items that were enacted recently. So within the Tax Reform Act, the active trade or business exception under 367A was repealed, and also the definition of intangibles under 367 was expanded. Unfortunately, these were not favorable to taxpayers. So with respect to the active trade or business exception, to the extent that you had, say, a foreign branch, which you're now going to incorporate into a foreign corporation, to the extent that there are assets which have an appreciated basis over tax basis, those assets are now subject to tax, whereas previously they were not under 367. And with respect to the expansion of the definition of intangibles, previously there was a carve-out for intangibles that were transferred to a foreign corporation, but now that has essentially been corrected, if you will. Perhaps previously viewed as a loophole, but these intangibles, they're now in scope as goodwill, going concern value, workforce in place, and other intangibles.
Hey, Randall, this
Yes.
is Brian.
Yes.
On these items, I think it's worth pointing out, for those clients that are thinking about moving or migrating to a structure that would take advantage of the new DRD opportunity, i.e. they would move to a C Corp structure and place their foreign assets and operating businesses into foreign corporations, these items would be very important here because essentially what it does is it essentially increases the gain that would be calculated in most cases and increases the base of taxability on the conversion event. So for example, if you wanted to convert a foreign branch or division into a foreign corporation and move that into a U.S. C corporation, most likely that would be a taxable event. And on top of it, the base, i.e. the fair market value, because of these definitional changes in intangible property, the fair market value would go up, i.e. the overall gain on this conversion to take advantage of the new DRD could be more expensive.
Absolutely.
Thanks, Randall.
Yes. Okay, a couple other miscellaneous items. Another item which was in the Tax Reform Act was as far as the sourcing of the sale of inventory property. Previously, if you recall, that was split 50-50 to the extent that there was U.S. and foreign source income. Now, for those sourcing rules, you're going to look solely to the place of production. So if the production takes place in a foreign corporation, primarily foreign source. If production takes place in the United States, primarily U.S. source. Another miscellaneous provision that we'll just talk briefly about here, which did get a lot of press throughout 2017, is the base erosion and anti-abuse tax, or otherwise known as BEAT. Now this applies only to the extent that there are average annual gross receipts of $500 million or more for a C corporation. And essentially this operates as a minimum tax. You're going to look at the tax underbeat and compare that to the regular tax liability and pay the greater of. A couple other miscellaneous provisions during 2017 is that there are, as far as Form 5472 under Section 6038 capital A, those were expanded to include single member LLCs, which are owned by a foreign corporation or a foreign individual. And previously, those had not been in scope within the Form 5472 requirements. Now, starting in 2018, the penalties for failure to file 5472 or failure to have a substantially complete 5472 are now increased to $25,000. So the IRS has been very adamant about assessing those penalties in the past, and now that they're going up by 150%, even greater detail will have to be paid to those forms. And also, last summer, the OECD released additional guidelines out of the country-by-country reporting as part of its BEPS initiative. I'll spend a few minutes talking about the Foreign Tax Credit System Modifications under the Tax Act. So starting for tax years after 2017, to the extent that there is when the DRD applies, indirect credits are generally repealed. Now, there are instances in which indirect credits do still apply, as Will was mentioning. It certainly applies with respect to the GILTI inclusions, also Subpart F Income, and also instances where an individual makes a Section 962 election. As far as direct foreign tax credits, i.e. withholding taxes, those are also disallowed under DRD, as previously mentioned. And also, there is no carry forward or carry back of foreign tax credits when these are disallowed. Again, for tax years beginning after 2017, for Section 78 gross up, this continues to apply except where the DRD does apply, i.e. We'll still have Section 78 gross up on GILTI provisions, for example. As far as the source rules, just mentioned that the 50-50 rule no longer applies. The effect here is, presumably, is that for most taxpayers, this can result in lower foreign source income and, i.e., lower utilization of foreign tax credits, unfortunately. As far as the added complexity that's now being added for the foreign tax credit baskets, we have a couple new baskets. One is for GILTI, and there the ability to use foreign tax credits is limited to 80% of the amount of FTC, which is otherwise allowable. There's also no carry forward to the extent with respect to GILTI inclusions in that basket. There's a new basket for foreign branch income. Now there are carry forwards allowed in that basket. To the extent that you have dividends which benefit from the DRD provisions or have a hybrid dividend, there is no foreign tax credit and no carry forward for those outcome credits. But we still have our general and passive baskets, as we always have, and those apply to the extent that as far as foreign source income was not allocated to a basket in the above categories. To the extent we have, you have income in the general and passive basket, the carry forward provisions do continue to apply. One simplifying provision is that there won't be the dual tracking with respect to AMT foreign tax credits as there has been in the past due to the repeal of the corporate AMT system. And just to clarify, there is no ability to use foreign tax credits when the BEAT tax does apply. I'll spend a few minutes talking about the tax accounting considerations under ASC 740. Now, under ASC 740, the general rule is that the impact of a tax law change is recorded in the period in which the change in law is enacted. Obviously, the Tax Act was enacted on December 22nd of last year, not leaving a whole lot of time for issuers to run through those changes. Obviously, the changes were quite substantial, given respective entities and their, what their structure was and, where that information might lie, in overseas offices, et cetera. So sort of high level, looking at the tax impact of the reduction of the rate, the U.S. corporate rate to 21%, as well as the foreign dividend received deduction provisions going forward, there'll be a need to revalue deferred tax liabilities, especially to the extent that there were unrepatriated profits, and there may have been those details reported previously. You certainly want to reassess your reinvestment assertion, given the tax-free repatriation in general, which is afforded by the foreign DRD requirements. But certainly when you do that, you will need to account for potential deferred tax liabilities on withholding taxes that could apply at the local level upon repatriation. And looking at the current inventory of deferred tax assets, certainly foreign tax credits, whether the value which existed prior to the Tax Reform Act is still valid, certainly may be in question, especially when you have foreign source income which can now be repatriated tax-free. The value of those foreign tax credits, which may currently be on the books, may need to be reduced. And also, in general, looking at your your valuation allowance considerations would certainly need to be revisited, whether that's due to structure changes, due to changes in the tax law, and those associated assumptions. So on December 22nd, the SEC also issued Staff Accounting Bulletin 118 and provided some guidance for issuers here who are currently working on their financial statements. So to the extent that data and computations are not readily available, provisional amounts may be recorded. And if this does apply, then the impact of the Tax Act needs to be recognized in later periods once that information becomes available and has been properly analyzed. To the extent that reasonable estimates cannot be formulated, the issuer should continue to provide for income taxes under former law until this is possible. Nonetheless, in terms under ASC 740, there is only a one-year period which is provided to analyze those changes, which would be December 22nd of 2018.
So, Randall, I think the big takeaway on some of these tax accounting considerations are for those of you that have a permanent reinvestment position and are going to move to the 21% rate and are potentially moving to the territorial regime with the DRD, the question becomes, do you continue to have a permanent reinvestment position? While the U.S. tax on that and the deferred item may no longer have to be set up, the big question is, what could the foreign withholding taxes be, and how large would that be? For those of you that are especially investing in countries that do not have treaties or a way to get the monies back to the U.S. in a tax-efficient manner, such as Latin American countries who have high withholding taxes occasionally, those should be considered, because if you eliminate or remove the permanent reinvestment position, what could happen is that you would then have to set up a deferred tax liability for those foreign withholding taxes, even though the U.S. Residual tax would go away.
Good point there. So we also have had some, as far as additional disclosures that would be required under Staff Accounting Bulletin 118. One will have to confirm the items for which provisional amounts have been recorded. To the extent that the existing deferred tax assets and deferred tax liabilities have been recorded under former law pending the additional information, that needs to be clearly stated. And where additional information needs to be provided to complete the calculations also has to be completely obvious within the financial statements. Also, an explanation of why the accounting remains incomplete, the effective tax rate impacts of the measurement period adjustments, and confirmation regarding the completion of analysis under the Tax Reform Act needs to be disclosed. Now, on January 10th, the FASB came out and issued additional guidance under SAB 118. They clarified that when the election has been taken to pay the repatriation tax under 965 over the 8-year period, there is no discounting of those tax liabilities. And also, where the GILTI tax regime applies and is expected to apply in the future, the question arose whether deferred tax assets and liabilities should be measured at the 10.5 effective rate under GILTI. Here, issuers have the option of recording those deferred taxes under the 10.5% rate, or just recording those costs as a period cost when they are incurred. That policy should be consistently applied and disclosed. To the extent that the BEAT tax applies, those taxes are only recorded as a period cost. And the FASB also indicated that they will be issuing more guidance in the near future with respect to the tax effects of accumulated other comprehensive income, or AOCI. Brian, you want to wrap it up here on next steps?
Absolutely. I think, thanks Randall, thanks Will. I think the big takeaways here are Section 965 is a 2017 tax item, and based upon some of our clients already, I think the big items are you cannot execute on this fast enough. Clients a lot of times when they're dealing with foreign operations find out that accounting systems are not tracking earnings correctly. They have functional currency issues. They have not converted correctly. So these can end up being some accounting system issues. You have to recalculate numbers. You have to apportion between cash and non-cash items to apply the right rates. And oftentimes, what are the tax pools? What do they look like historically? Remember, your foreign earnings are kept in your foreign currency, but your tax pools are converted annually into a U.S. dollar amount. And if you have not been converting your tax pools, and those tax pools are not available on the 5471 for totals, so you have to go back and do an exercise to calculate what those tax pools look like. So I would say for those that may have a 965 impact, getting involved right now would be of high importance on the priority list. Number two, those elections under 965, if you want the installment election or if you're eligible under the S corporation, those need to be made by the date of the filing of your tax return without, and I do repeat, without extensions. If you are a filer that has financial statements, those transitional rules and how 965 is going to impact in your permanent reinvestment position is going to be very important. Also, third point here is evaluate your global structure. Are you in the right structure now given the new territorial regime opportunities? Is this right for you? Do you want to take advantage of a DRD? Can you get the money back all the way to your investors for as low as a 23.8% tax rate? And then finally, I would mention quickly here is the big deal is IRS guidance is needed. We've had two notices. One has been published. We already have another notice that we have access to on 965. We're expecting another one. I will say the IRS is actually in this area. The people there are very professional, and they are acting on this very quickly. They've been very responsive, and we hope, I know they have a lot on their plate, but they also know that we need this guidance, and we're waiting forthcoming guidance. But it is coming out, and it is actually coming out pretty quickly. They issued one on December 29th, and like I said, they issued one on 965 just as last Friday, even though it's not published yet, but it will be this week. So that's really it. Everybody focus on 965. It's a big accounting. Number two, get ready for more compliance and comprehensive accounting. And then number three, are you in the right global structure? And that's it for me, Sarah.
Great. Thank you guys very much for your attention. I could see we had a number of questions coming up in the chat pod today. We thank you for those. We will be addressing those as they're coming up. Also, and we'll get back to you if we have not been able to answer your questions. Also, you may certainly reach out to these individuals and ask your questions directly, and we'd love to talk to you about the new tax law and how this extraordinary change to the international taxing regime is taking place. Along those same lines, I have to give a bit of a promotion to our upcoming webinars. In the next couple of Tuesdays, we'll be dealing with these other areas, not-for-profit, coming up next Tuesday, January the 3rd, and then on the 6th, dealing with high net worth individuals, trusts, and estates, and how the new tax law is affecting those taxpayers. Finally, on February 13, we'll be dealing with choice of entity, because that just keeps coming up time and time again as an issue, and how do we rethink the organization that we're using to conduct business in under the new tax law. And finally, on February 20, our state and local tax group will be addressing what they hear as the latest news from the states and how they're responding and reacting to